trader, and welcome back to my YouTube channel. It's your boy here, the Forex Amateur, and we're going to do another educational video. So in keeping with the ongoing conversation about market structure, I think this is pretty much either the last or the second to last video that I am going to do on this specific topic. But as I mentioned on the last video that I did, that I will be doing a video that will basically highlight how to identify your trading ranges, right? So we use market structure to basically firstly identify what is the direction or the general direction that the market is traveling in or toward. And once we've done that, we then use it to identify the range that we will most likely be trading in, right? So the purpose of today's video is to firstly show you how to identify your range, and then secondly, how to basically work that range and how to get in and get out of the market in a way that is most likely going to be profitable. Remember, I am not licensed to offer financial or investment trading advice. Everything I speak about on this is purely educational content. I do not recommend trading live funds, but if you do make the decision to do so, make sure that you risk cash that you are willing to lose, right? Because the Forex market, especially trading leveraged products, is very, very risky. So without further ado, let's just get straight into it. Now, we've obviously done a few videos already, how to identify your trend, how to basically identify where you are in that trend and so forth. But one of the things that I want to talk about before I get into identifying your range is the nature, right? So you must be able to identify the nature of the market that you are currently in, right? Of market, right? Now, obviously, there are two, in terms of the nature, what are we talking about? There are two specific terms that I use in order to convey this message. The first one is impulse, right? So an impulsive market in terms of the nature is a market that is moving continuously in one direction, right? Doesn't necessarily have to be all bullish candles, doesn't necessarily have to be all bearish candles, but it is impulsive in the fact that it is doing what? It is breaking market structure. So it's breaking market structure, number one. What do I mean by breaking market structure? In a bullish market, it is breaking previous highs. In a bearish market, it is breaking previous lows, right? So that's the most important thing. It's impulsive and it is breaking market structure or breaking resistance, or let's just put it as support and resistance. So if you trade support and resistance, it's breaking that, or whatever other indicators that you use in order to identify what your market structure would be, right? So the nature of the market, the first thing that we would look at is it impulsive? Is it breaking market structure? In a bullish market, is it breaking previous highs? In a bearish market, is it breaking previous lows? If it is doing so, secondly, what we would look at is what is there a lot of volume? Right? Is there a lot of volume? Is it aggressive in its movements? Is it forming bigger candles, much bigger ranges in terms of one candle? And when you identify this, generally an impulsive market would have a lot of volume in that specific direction, and it will then be breaking market structure as well. Number two that we look at in terms of the nature of the market is corrective, right? So a market that is corrective is operating within a higher time frame impulse leg, right? What do I mean by a higher time frame impulse leg? So in a bullish market, let me just draw this a little bit. In a bullish market, right, this here to here will be a corrective leg, right? From here to here would be an impulsive leg, right? So this would be we're just working under the assumption that obviously there are previous highs and lows in this market, right? So firstly, it's broken market structure, it's impulsive, and there's a lot of volume in the push, and it's breaking previous highs. So this is a leg, right? So this here would be one leg, and then from here to here, if it breaks this previous high, this would be another leg in here. People also refer to it as levels. I don't specifically count levels because it creates a certain expectation, which I don't necessarily subscribe to. But in terms of that, an impulsive leg is breaking market structure. It's got a lot of volume in that it's moving in one direction. A corrective leg is where price is operating within a specific impulse leg of the higher time frame or of that specific time frame that you're looking at. It is not necessarily breaking, let's just put it as, does not break lows of the impulse, right? And this is obviously in a bullish market or highs. So let's just put it as does not break lows or highs of the impulse, right? Obviously, you need to use your discretion in this, because in a bullish market, it will not break the lows. In a bearish market, it will not break the highs. The highs will be respected, right? In a bullish market, the lows will be respected. A corrective leg in the market or a corrective phase within the market, it's also generally, it's very consolidating, right? So consolidating, um, not necessarily a lot of volume, right? Not much volume in it. And like I said, it is respecting the lows in a bullish market or respecting the highs in a bearish market, right? Not much volume. So once you understand this, right, this is the very first thing that you need to also understand before you identify your range. So you need to identify, okay, this is a bullish market. Why? Because it's making higher highs and higher lows, respecting previous lows, breaking previous highs, right? That is the very first thing that you need to look at. Once you've identified this, you also need to also look at your volume. So how is the volume in the candles? So if it's a bullish market, is there a lot of volume to the upside? Is there a lot of momentum to the upside? And if it's a bearish market, is there a lot of momentum to the downside? Once you've identified that, now you need to identify what phase are you currently in. So we talk about the nature of the market, impulse and corrective. So impulse would be one phase, corrective would be another phase. In a bullish market, you want to identify a corrective phase, and that is generally when you're going to look to get in on a trade within that corrective phase and basically ride the next impulse to the upside. In a bearish market, you're going to look to get in on that corrective phase much closer to the previous highs so that you can ride the next impulse to the downside, right? So now that we've identified that, let's just basically draw something out really quickly. And this is basically going to be the scope of today's conversation. So on this side over here, let me actually make this line a little bit thicker so that my drawing doesn't look so bad. So this is a bullish market. And this is a bearish market, right? So forgive me for the drawing. As you guys know, I'm not really the best at that. But you know what I'm saying? We still kill the market regardless. There's no drawing required in the market. So looking at this now, what do we identify about this market specifically? We identify that, okay, that's our low, that's our high. This is a higher low, but we are only interested in this market once it breaks this previous high. Then we will be looking at somewhere inside of here for some sort of confirmation to keep riding this market to this previous high that was created after this break in market structure. And we'll then be looking to target this level here and maybe hold it until the market obviously stops pushing to the upside. So when we look at this now, we would expect this to be a much more impulsive push to the upside, in that there will be much stronger candles, a lot more momentum in these candles. When the market is pulling back here, generally what we would see is we would see some sort of a contracting pullback in here, where the way I basically use it to identify it is you see the most clearest market structure per se in these corrective pullbacks, or this corrective, let's call it corrective. So generally when the market is in a pullback, it's in a correction, it's not in an impulse, that is when you would see the most clearest market structure, because generally in an impulse you will just see continuous big ass candles, continuous big ass candles, and the market on a lower time frame, obviously this is doing that on a lower time frame, but on the time frame that you're looking at, you generally just see a continuous push to the upside, and then generally your cleanest market structure will be in that corrective move, and then again another high volume push to the upside, and then you'll see a contracting pullback like this, where the market is making clear lower lows and lower highs, right? But now let's look at this from this perspective. when we're trading, right, we're going to be looking at, let's take that off from there. Now, obviously, I'm just going to put numbers on here, right? So we know that this is our structure low, that's our structure high. This is a higher low, right? I'm just going to put HL there. That's a higher low, but we are only interested in this market once we see this point in here. Once we see a break of market structure, remember that we need to see a full-on candle close, regardless of how much of the body of the candle closes. We just need to see a candle close above this previous high in here, and that would be considered a market structure break. So the market breaks structure at this point in here and forms a higher high, right? So that's a higher high. Now we are able to identify our ranges in this market at this point in here. And let's just work under the assumption that, let's say, for instance, this is the H4 chart, right? We're looking at the H4 chart. Obviously, you're not going to enter based on the H4 chart, but the H4 chart is going to give you your setup. Your setup. Wow, Ryan. Wow. But anyway, the H4 chart is going to give you your setup, right? Or your bias, depending on what type of a trader that you are. I generally look at the H4 chart for my setup, and then I look for confirmations on whether it's the 30-minute or 15-minute, but most likely it's going to be the 30-minute, and then I enter either on the 30-minute or I enter on the 5-minute if I have the time to go down and wait for another confirmation. So let's assume we're looking at the 4-hour time frame on here, and we can see, okay, we've got a break of market structure and we've got a new higher high formed. Now we have enough information for us to be able to identify our range. The very first thing that we're obviously going to do in this instance is, let me just, oh, wow, let me just remove this off here. Right. So the very first thing we're going to be doing on here is, number one, we want to mark out that this market structure was broken, right? You can either leave that line on there or not. I don't generally mark this up on my chart. Once you've done that, you now need to identify your range. As I've said on the bullish market structure video and the bearish market structure video in 5 minutes, which you can always go back and watch, I've spoken about the fact that in a bullish market, the broken high and the low that was formed before that high was broken will be a level of support. Excuse me, will be a level of support. In a bearish market, the broken low and the high that was formed before that low broke will be a level of resistance, in that that will be the general area that you will look for the market to come back and respect. So within that little zone is where you can look to take a trade. Now, we're going to firstly mark out our level of support in this instance. Now, understand the fact that I do not use support and resistance to trade, but just in order to convey this message, I do use terms such as that because it's relatable, right? So in this instance here, because we're looking at a bullish market structure, the broken high and the low that was formed before that high was broken is going to be our level of support. I'm just going to put that in here. Support, right? Now, what you initially want to see, right? Before you know now that when the market comes back down into this area here, you're looking to jump in on a trade and take this market back to the upside, right? However, you need to be looking at certain characteristics of how that pullback is happening. Remember, in a bullish market, your impulse is to the upside, and then your correction is generally to the downside. So when this market does pull back, you want to see it pull back in this type of a nature, right? So the nature of the pullback needs to be something where it's giving you like lower highs, lower lows, pulling back into here. Now, remember, this doesn't necessarily mean, because it's breaking previous lows, doesn't necessarily mean that this market is now going bearish. Why? Because it has made a higher high and it has made a higher low, right? Now, in this instance here, we can clearly identify that this market is currently bullish. Now, at this point, I will refer to what I would call your range, right? So let me just change the color. Let's put a yellow. So your trading range will be from this level here up to this level here. So that is your range. You've already formed your bias in this market in that you are now bullish on this market, right? No matter what happens inside of here, you are looking for buys. It can be pulling back and breaking previous lows, breaking previous highs, whatever it is, it doesn't necessarily matter because inside of this area here, all you're looking for is confirmations to take a trade to the upside. Now, remember, even though this is your level of support, doesn't necessarily mean that the market has to come into this area. In most cases, basically about say 80 to 90% of the time, it will most definitely come back into this area and give you maybe a double bottom in there, or come back into this area and then give you a bullish engulfing candle in there, or come back into this area and give you a head and shoulders in there, or whatever it is, give you a moving average crossover, give you a RSI divergence, whatever it is that you're going to look for in terms of your confirmation. But generally, it would most likely come back into this area. You are using this area, however, as your area of validation. If the market does break down and close, the most important thing is if a candle breaks down and closes below here, you are no longer going to be interested in looking for buys to the upside, right? Because now this level has now been broken to the downside. Remember, in a bullish market, you want to see those lows being respected. So very simply, the range that you're trading is from here down to there, right? The area that you're going to be looking for an entry for, or the area that's going to validate your analysis, is going to be within here. You do not want to see the market breaking below this previous low. So that basically covers it, right? Now you're going to see your impulse to the upside and you're going to see a corrective pullback down into here. Once you've seen that, whether the market wicks down into here or whatever it is, you're going to be looking for your confirmations around this area here. And because this is your range, your first targets is going to be at this previous high in here. Because in a bullish market, the highest probability is price will most likely make it back to the previous high because you're in a bullish market, right? You can't guarantee that it's going to break the high and continue bullish, but there's a very high probability that price is going to make it back to that previous high. Okay, so this is a bullish scenario, and this in here is your range. That is your range, right? Now, obviously, once price has broken and goes up to the upside, your range will now change and it will now be, oh man, I shouldn't have done that. Your range will then change and it will then be from this low up to that high, and then your level of support will change. It will be from the broken high to this level down in here. And all you do is you just keep following the market up to the upside. But remember that the higher you get in this move, I wouldn't recommend taking maybe the second and third, maybe the second pullback you can take it. But from the third pullback upwards, I wouldn't necessarily recommend taking those trades because the higher you get in the range, the more likely price is to pull back, right? Or the higher you get in the trend, price is more likely to pull back, right? So I generally look at getting in on, generally, for me, I'm generally in on a trade around here. At latest, I'm in here, right? If I see a good opportunity here, I would take that trade. But after that, I'm no longer interested in taking that. I'm now looking for opportunities to the downside while still holding these entries to the upside, right? So it's just a matter of you're going to do your back testing and you're going to identify what works better for you, and then you will be able to trade in those directions, right? Now let's switch it over to the bearish side. Now we can see in this instance here, price came, that was our last higher high, price still made a higher low. Why is this still a higher low? Because you simply compare it to the previous low, and this low is higher. Why is this a higher high? You simply compare it to the previous high, and this high is still higher. So in terms of your structure points, this is your higher high, your last higher high. If price breaks above here, it's most likely going to go bullish. If price breaks below here, it is most likely going to go bearish, right? Remember, this would be the third pullback in this instance here. So it's not necessarily recommended to trade it, but you can. If you've done enough back testing, you are able to have a good approach to where you're ensuring that you're going to get to either break even or you're going to get to a point where you can at least secure a certain amount of profits, then take the trade. You know, it's all about what works for you. So looking at this now, we can say that, hey, this is now our range from there to there, from there, sorry, to here. That is now the range, right? So if you can see a good enough opportunity inside of here and you know, hey, I can manage this trade maybe to break even, or I can manage this trade to a 1-to-1 or 1-to-2 or whatever it is, then you can still take that trade. So now what we're looking at in here now, let's remove all of this off there and let's just look at the structure. So we can see that, okay, price made that higher high, that higher low. Now we're simply monitoring. Why? Because we know we're very high in this range, right? This started down here and we're now all the way up here. So it's very likely, remember, you must have an underlying bias in that maybe on a higher time frame, because this is the H4 chart, like we said, perhaps on your daily chart or even your weekly chart, there's a reason for price to be turning somewhere around here, right? Remember, nothing is ever just an assumption. It all is a calculated guess, because that's what trading is. It's all about stacking up building your case per se, and then taking a trade in the direction of what makes the most sense. If price is 20% probable to go bullish and 80% probable to go bearish, you're obviously going to take the trade in the bearish direction. Doesn't necessarily mean that it's definitely going to work, but it has a much higher probability of working. So we can now identify, hey, price broke up to the upside, but when it came back, right, if you were still looking at this as a range, when it came back, it failed to respect this low in here, and instead it broke down and it made a lower low. Once we identify that, we've got 3 structure points in here. We've got a break of the previous low, we've got a formation of a lower low, and we've got this, which is still a higher high in comparison to this and this as well, right? So now we're simply looking at the fact that we've got a higher high, but we've got a lower low. In this instance here, all we're going to be looking at, remember, I said in a bearish market, price will most likely form some sort of a resistance from the broken low to the high that was formed just before the low was broken. So if you'd like, you can look at putting up a range in here, and you can look to see whether price is gonna come back into this area here and respect this sort of range that you've got in here. And as you can see in this instance, price did pull back and respect it. So at this point in here, I do take trades at this specific point here, but it is the first pullback, so you could always wait for price to break structure again and then look to take a trade. But we're going to look at this for now, just because I don't have that much drawn on here. So as we can see in this instance, price is now broken. We've formed what? What have we formed in here? We formed a lower low, right? We can see price formed a lower high at this point here. So now we've got enough information for us to look for a trade here, or if we're being conservative and we're being conservative in our approach, we can wait for price to break this low in here, and then we can look to take a trade in there. So let's look at that for this specific scenario. Now, price has done so. What have we identified in here? We have identified our level of resistance. We can now move that down to here, right? Because now this level has broken. So price has broken this low. So from the broken low to the high that was formed before the low was broken, that is now our level of resistance. If we're identifying our range will be from the high to the low that was created after the break in market structure. That is now the trading range. What does this mean? This means that obviously when price does pull back into here, right, we can look for some sort of an entry in here, and then we can look at targeting this level. So very similar to what we did here, where our first target was up there. After the pullback, in this instance here as well, our first target is here, right? Like I said, in this scenario here, in a bearish market, price has a very high probability of getting back to that previous low. In a bullish market, has a very high probability of getting back to that previous high. And that is simply what trading your ranges is. So let me just clear this up again, right? Once this high is broken, right? Sorry, wrong high. Once this high is broken, this becomes your structure low, that becomes your structure high, right? That becomes your structure high there. So in this instance here, that's your trading range. If you take a trade from here, you're looking at targeting that level in there. Remember, you're most likely going to see like a corrective pullback here, and then you look at taking this trade. Remember, you can always find a management process where you simply trail your stop loss so that you can ride this up as much as possible. Moving over to the side, once price breaks this low, gives you your confirmation lower low, confirmation lower high, you know that price is most likely going to get back to this low in here because you do have a switch, right? Remember, our identifiers is making a lower high and a lower low, right? Our validators is respecting a previous high and breaking a previous low, right? So in this instance here, we know that there's a higher probability price will get back into here, and you can then have your trailing stop loss, whatever it is that you're going to do in that instance. When price breaks another low in here again, you can look for marking this up here, your resistance, that as your resistance, and then you look for your entries in there. If you're looking for entries in here, your trading range is from here to here. Price is most likely going to get back to that level. And if you're looking at this here to here will be your trading range if you're in on there, right? Because this is now a lower low, sorry, lower high, and this is a lower low, right? So when price does break this low in here, it's now formed this. So your range is basically your previous low that was broken, sorry, your previous high and your previous low in a bearish market. And in a bullish market, it's your previous high and your previous low. What do I mean by that? Previous low, previous high. On this pullback in here, this is your target. Previous low, previous high. On this pullback here, this is your target, right? And that is all you're looking at because this is the highest probability. If you are able to get out a, let's say a 1 to 3 risk reward ratio in here, then there's a very high probability that, hey, at this point here, you can take a whole lot of your profits. You can even move your stop loss above your entry and you're now risk free. That is the most important thing that you need to identify. All right, so I'm going to end it on that note. I hope this video was educational enough. Remember, if there's anything that you want to suggest us to speak about again, just pop it down in the comments and I'll be sure to address it on the next video. Until next time, it has been a pleasure as always to share with you, and I'm wishing you a blessed and a profitable trading day, and I'll catch up with you guys on the next video.